Lesson 13, Gross Domestic Product. Now, GDP refers to the total value of all goods and services produced within a country within a given period. Now, generally speaking, GDP is a measure of production in a country. So if GDP is going up, production is going up, and the country is experiencing economic growth. Now, GDP is a lagging indicator and is released quarterly. Now, what I mean by lagging indicator is that you will see a change in GDP after the changes already occurred in the economy. So, GDP is not a leading indicator. Leading indicator signals change before change occurs. And examples of leading indicators are like PMI, Consumer Price Index, but GDP is a lagging indicator. So you'll only see a change in GDP after there's a change in the economy. And GDP comes out quarterly, that is every 3 months of the year. So always bear in mind that GDP is a lagging indicator and it comes out on a quarterly basis. Now, rising GDP is a positive sign. Why is rising GDP a positive sign? This is as rising GDP signals growth, and as the economy grows, there is increased inflation. Remember, the main tool used by central banks to control inflation is raising interest rates. So rising GDP is positive for a currency. So if we see a rising GDP for the euro, you can expect strength in the euro. This is because rising GDP signals economic growth. Okay, now, higher interest rates make money more expensive to borrow and thereby reduce spending by those who produce goods and services. And this is why central banks raise interest rates to combat increasing inflation. This is because when the central bank raises interest rate, it makes money more expensive to borrow. And when money is more expensive to borrow, there's less spending. And less spending leads to less demand. And less demand leads to lower prices. So this is the effect that raising interest rate has. Also, more persons feel the urge to save and invest in long-term investments. This is because there is more interest to be gained on your savings and more interest to be earned on your long-term investments. So there's an increase in purchasing of government bonds and fixed income investments. So higher interest rates make money more expensive to borrow, and as a result decreases the circulation of money in an economy. Okay, and lowering interest rate has the opposite effect. Lowering interest rate makes money cheaper to borrow, and as a result more persons borrow money and there's more spending, and as there's more spending there's more demand because more persons have money to spend, so more persons are willing to purchase goods and services, and as a result the price of goods and services increases. So this is the effect of raising and lowering interest rate. Now in the next lecture we'll be looking at the non-farm payrolls.